Welcome to the Great Reset Opportunity Report. My name is Chris Blasi. Today we have a guest with an extensive resume and is a true asset to have on to discuss the scope and magnitude of the Great Reset. This individual has a background that includes investment banking, being an economist, and a lawyer. He has also served in senior positions on major financial firms such as Citibank and Long-Term Capital Management. He has also authored several bestsellers, including Currency Wars, The Death of Money, and The Road to Ruin. He also edits a financial newsletter called Strategic Intelligence. I'm very pleased to welcome to our viewers and listeners, Jim Rickards. Jim, welcome to the show.
Thank you, Chris. Great to be with you.
Thanks, Jim. You know, we usually like to start off this show about defining the Great Reset. And what we mean by that is there are a lot of pundits and analysts who are using the word reset when they're talking about trade deals and relations between sovereign nations and even monetary systems and financial systems. So we'd like to start with, what is your definition of the Great Reset?
Well, it's a great question, Chris, because, I get, and others get involved in a lot of debates and people start arguing about things. And at some point you realize that they don't even agree on the definition. So you have to start there. You have to agree on what the definition is. Mm-hmm. Then you can have your debate. But if you don't even agree on the basic term, you're not going to get very far. So to me, the reset is obviously it's a new international monetary standard of some kind. We've had many of them. They're not as rare as people think. It's not like you have to wait, 500 years for the fall of the Roman Empire or, the collapse of the Bronze Age. Those are big events that happen every, 1,500 years. But we've actually had several, three in the last 100 years. So these resets, and I'll talk more about what I mean by it, but they happen every 30 or 40 years. So, and it's been about 45 years since the last one. So we're kind of overdue. But a reset is basically a change in what scholars and policymakers call the rules of the game. It sounds like a rigged system, and it is a rigged system. You have to, if you're going to have an international monetary system, there has to be some agreement on what's money, who issues it, how do you exchange it, what's it worth, what counts in reserves. There are rules that apply. And so it's really a change in the rules of the game. The last big one was August 15th, 1971, when Richard Nixon ended the gold standard for international transactions. Of course, Franklin Roosevelt had ended the gold standard for U.S. citizens in 1933, but it still applied for international transactions up until 1971. So a reset is, as I say, basically an international monetary conference of some kind. It could be a lot of sponsors. Could be the United Nations. It could be the G20. I think that's probably more likely. It could be just President Trump, giving a press conference and saying everyone's invited to Mar-a-Lago next week and we're going to reorganize the international monetary system. But there's a little more to it than that. But so it's very, very significant because it usually implies either a switch from fixed exchange rates to floating exchange rates, or the opposite. You could be flipping from floating exchange rates to fixed exchange rates. The minute you talk about fixed exchange rates, it begs the question, well, fixed to what? And the best answer is gold. I mean, that's I have a personal preference for that, but it's not just my preference. Historically, that has been the best anchor. I don't see a gold standard on the horizon in the very near future, but more in the intermediate term, it's definitely a possibility. So by reset, we mean a new international monetary system agreed among the major trading nations. So today, that of course would be the United States, the EU, Canada, UK, China, Japan, a few others, but Russia would be part of it. But and then all the smaller nations would kind of have to go along for the ride. So right now we have, I would say, almost no system. That sounds like an extreme statement, but I think it's a pretty good description. I've had conversations with two of the most important players in this. I had a private conversation with Ben Bernanke in South Korea not long ago, and I had another conversation one-on-one with John Lipsky, who was the former head of the IMF. John has two distinctions. He had the shortest reign as the head of the IMF. It was about 3 months, and he's the only American ever to head the IMF. The agreement at Bretton Woods was that the IMF would always be headed by a non-American. It's been exclusively European, predominantly French. So you had Jacques Larosière and Dominique Strauss-Kahn and Christine Lagarde. It seems to be a little bit of a French monopoly, but that it would never be an American. An American could head the World Bank, and someone else, primarily European, would head the IMF. But of course, we all know our friend Dominique Strauss-Kahn got hauled off an airplane, Air France flight by NYPD in 2011, and had to resign a few days later. And the executive committee was not ready with a replacement. Nobody was expecting that to happen. It took some months to settle on Christine Lagarde. So in the meantime, John, who was first deputy managing director at the time, became head of the IMF. But he was the head of it, and I spoke to him as well. And interestingly, they both used the same word to describe the international monetary system today. They said incoherent, meaning there's no frame of reference, there's no standard. I don't think either one of them would favor a gold standard, but they favor, or at least were suggesting some kind of standard should be put in place, and there isn't one today. And I think that's exactly right. Mm-hmm. And as I say, these conversations took place about 9,000 miles apart, so they weren't rehearsing it for my benefit. It told me that word incoherent is kind of in the air among the global monetary elites. So I think that's right. We have Milton Friedman, and at the time Nixon went off the gold standard in 1971, Milton Friedman was sort of at the height of his powers as an economist, and Nixon listened to him, and Friedman made a very powerful case for floating exchange rates. I think his case was badly flawed, but nevertheless it carried the day. We've had floating exchange rates ever since. We've had one financial panic after another since then. The 70s were a complete mess. We had the 1987 crash, the 1994 tequila crisis, the 1997-98 emerging markets, long-term capital management Russia crisis, 2000 the dot-com crash, 2007 the mortgage crisis, 2008 global financial panic. So I think it's fair to ask, how's that working out in terms of an international monetary standard? But we did have one anchor through a lot of that period from, I would say, 1981, when Paul Volcker got inflation under control and Ronald Reagan got the U.S. economy moving, through Republican and Democratic administrations, Reagan, Bush, 41, and the Clinton administration, and several good secretaries of the Treasury, James Baker and Bob Rubin, among others. We were on a de facto dollar standard. We said we'll keep the dollar. Strong is not the right word. You could use the word strong, but it's more stable. We're not going to let the dollar fluctuate a lot, and all you other countries can anchor to the dollar if you like. And that's the new gold, if you want to think of it that way. That worked fairly well in the 80s and the 90s, but it kind of blew up in 1998, then kind of reestablished itself. But then beginning in 2010, President Obama launched the currency wars, and the dollar hit an all-time low in August 2011. By the way, it was no coincidence that the dollar hit an all-time low the same week that gold hit an all-time high, the $1,900 now. So they're just inversely related. Cheap dollar is a high dollar price for gold, and strong dollar is a lower dollar price for gold. So those two things are connected. That's not a total shock. But in any case, we don't have an international monetary standard today. We do need one, because if you don't have one, the uncertainty and the volatility and the cross rates translates into less direct foreign investment, less willingness to commit capital, slower economic growth, more transaction costs, et cetera. So we're in a ship, or at sea. We don't have a compass or a chart or GPS or anything else. Elites are looking for a standard, but there's no consensus. And now, you throw the trade wars on top of it, and maybe a new Cold War with China, and I think that is an accurate description. You pretty quickly get to the point where there's sort of chaos reigning in international exchange markets. Now, the question is, how and when are we going to get to this reset, new paradigm, new rules of the game, however you want to describe it? And there are lots of ways you can envision it. A gold standard is one. using gold as a reference point, which Greenspan did in the 80s and 90s, where it's not a strict gold standard, but you say, well, we're looking at gold as one of the input factors in terms of exchange rates, or something else, something like the IMF special drawing right, or fixed exchange rates without a gold standard, or some combination of the two. They're all possible. There are two ways to get there. One is the smart way, which would be that, policymakers would first of all, see the problems. Second of all, see the costs and the potential, monetary collapse or financial panic coming, and get together and voluntarily sit down and work out a new system. And that's what happened at Bretton Woods. The other way, which is a lot uglier, would be no one does anything. The system gets more and more wobbly. There is a panic, and you have to do it under duress. You have to put it together in 3 months or 6 months, because if you don't, the entire system is going to collapse. Pardon me. I would certainly recommend the former, but I think the latter is more likely, because we don't have the degree of cooperation and trust. We don't have enough policymakers who see the problem. There are some, but even if you see the problem, are you kind of proactively pushing a solution? I don't see any of that. And so my expectation is that sooner than later, there'll be another financial panic. It'll be worse than 2008. Instead of central banks bailing out Wall Street and commercial banks, someone's going to have to bail out the central bank and the central banks. And the only entity on the face of the earth that can do that is the IMF. And so some combination of G20 and IMF on an emergency basis are going to sit down and hammer this out. But I don't believe for a second that gold will not be part of it. And I think this is evidenced by the fact that Russia has tripled its gold reserves in the last 10 years. China has tripled its gold reserves in the last 10 years. Many other countries, even Poland, which is a member of the EU, their central bank bought some gold. Kazakhstan, Turkey, Iran, you see it all over the world. These central bankers are not dopes. They're buying that gold for a reason, which is they see it's going to be part of the future and they want to be ready for that. So the short answer is it's a very big deal. To me, reset is basically new rules of the game, a new international monetary standard. I would look at Bretton Woods as one model, but certainly not the only one. And I would say it's coming sooner than later and that gold will be part of it. But again, my concern is that this is going to be something drastic and hurried in a new financial panic rather than something proactive.
Sure. And I agree with all those points. I just want to look at something real close to home right now. Over the last number of years, a lot of analysts have looked at a lot of data points that are saying the U.S. economy was facing a lot of headwinds. Now, over the last year or so, we're getting a lot of data, such as the unemployment rate, GDP growth, that is showing the U.S. economy as being robust and very powerful. Now, what is your opinion as far as the true viability of the U.S. economy right now and going into the future?
Well, it's a great question, and you're absolutely right. The thing is, you can have different opinions or different views of where things are going, but facts are facts. You have to kind of take the data as it comes. In the second quarter, we had real GDP growth over 4% in the United States. Best estimates for the third quarter look similar, somewhere around 4%. Although what's interesting there is I look at the Atlanta Fed GDP, what they call the nowcast, which is kind of a real-time forecast. But the New York Fed started one also. And there's a big gap between the two of them. Atlanta has been pretty accurate, pardon me, over time. But right now, Atlanta's about 4.1, and New York is about 2.7. So that's a big difference. We'll know, I think, late next week, though, the Commerce Department will release the GDP for the third quarter, so we'll know more about it. But a big difference there. So growth has been strong. Inflation up a little bit, but not out of control. I know inflation expectations are higher. I don't really see what's going to drive inflation, but but it is up a little bit. The question is this a temporary blip from the Trump tax cuts, and is it sustainable into 2019? Now, if you listen to Larry Kudlow and Art Laffer and Steve Moore and Steve Forbes and a lot of advisors to President Trump, and including the head of the Council of Economic Advisors, they'll tell you, yeah, this is the real deal. This is the Laffer curve at work. We cut taxes. We're getting higher growth. It's going to be a replay of Reagan. And what happened in the Reagan years in 1980, 81, and 82, we had the worst recession since the Great Depression. It wasn't as bad as what happened in 2008, 2009, but it was pretty bad. And it was, as I say, the worst since 1929. And then in 83, 84, 85, and 86, in that stretch, growth was phenomenal. It was, I think there was a 3-year stretch, 83 to 85, when it was 16%. We were banging out over 5% per year real growth. So, and the people I mentioned were all around then. They're a little bit older now. That's okay, but they were all veterans of the Reagan Revolution. So you had Kudlow and Laffer and Moore and Forbes and others, in the game in 1981, and they're back in the game today. So as far as they're concerned, this is just, hey, take out the Reagan playbook, cut taxes, cut regulation, get out of the way, let the U.S. economy rip, and it's all good. But there are major, major gaps in that logic. There are important differences between where we were then and where we are now. Let me just illustrate a few of them. In 1982, as I mentioned, we were coming out of a severe recession. Well, one of the things you expect at the bottom of a severe recession is high growth. In other words, it's a business cycle. And so once the economy dips the way it did then, assuming you don't make it worse, which has happened, but assuming you don't, you would expect very high growth, and the fact that growth would exceed trend, get growth above the trend line, and then settle back down to the trend line. In other words, what you lost in the recession, you make up in a very strong recovery, and then you get back to trend, and then life goes on. And it was also the case back then that the debt to GDP ratio was 30%, which is historically very low. I mean, everyone's comfortable with 30% debt to GDP level. That's completely sustainable and manageable, which meant that Reagan had a lot of headroom to use fiscal policy. And he did. The idea that Reagan was some kind of conservative when it came to spending is nonsense. Reagan took the debt to GDP ratio from round numbers 30% to 50%, 50. That was a 60% increase in the debt to GDP ratio. Now, to his credit, a lot of that went to defense, and we did win the Cold War. So nice going. I mean, we got something for the money, but make no mistake about the fact that Reagan was a big spender. So between tax cuts, big spending, defense contracts, coming out of a severe recession, you would expect the economy to grow. I mean, I'm a big fan of Ronald Reagan. I give him a lot of credit, but I think you could have put, Popeye in there, and we would have had good growth in 83, 84, and 85. Now, flash forward to today, 2017, 2018. So Art Laffer and Kudlow and these guys, they're trying to run the same playbook. They say, hey, Mr. President, cut taxes, cut regulation, we'll grow like crazy. But look at the differences. We're in the 9th year of an expansion. Now, it has been a weak expansion. I'll acknowledge that. And I'm not saying we'll have a recession tomorrow. But the 9th year of an expansion is very different than the bottom of a recession in terms of the impact of fiscal and monetary stimulus. You have to be kind of crazy to be goosing the economy 9 years into an expansion. We're probably closer to a recession. You probably want to keep some dry powder. That's one difference. But the bigger difference is that the debt to GDP ratio is 105%. It's not 30% when Reagan got there. It's not 50% when Reagan left. It's not the 60% when George Bush 43 came in. George Bush increased the debt to GDP ratio upwards of 80%, and then Obama doubled it again, took it to 105%, which is where it is today. And Trump's tax cuts are on track to take it up to 110 or 115%. We're not that far behind Italy. Remember when the U.S. is making fun of Italy? Oh, the poor Italy, their deficit's out of control. Well, the U.S. is not far behind when it comes to debt to GDP. And it's not just the tax cut. The tax cut's maybe $1.4 trillion of deficits added to the baseline deficit that we already had. But on top of that, last January, the Congress had this, what they call a sequester, or these ceilings on domestic and defense spending. And the Republicans wanted to increase defense spending, and the Democrats wanted to increase domestic spending. So they compromised and did both. They removed the ceilings completely, and that's added $300 billion to the deficit. And then on top of that, there's, just demographically, entitlement spending is growing out of control. That's on autopilot. And then in addition, the thing nobody wants to talk about are student loans. Now, right now, the U.S. Treasury guarantees approximately $1.6 trillion of student loans. Bear in mind that at the start of the mortgage meltdown in 2007, we were looking at about $1 trillion of subprime and all-day mortgages. All-day is just a kind of a subprime junk mortgage. But here we have $1.6 trillion of student loans, and those default rates are skyrocketing. They're pushing 20%. In mortgages, if you get to a 5% default rate, it's, hey, it looks like the end of the world. 6% is Armageddon. Well, you're looking at 20% default rates in student loans. And that stuff is off budget until the loan actually defaults. So the way it works is the Treasury guarantees the loans, the banks make the loans, then they hire third-party servicers, or they do their own servicing to handle the loans. Well, when the loan goes into default, there are all kinds of workouts and grace periods and all that stuff. But once you get through all that, the bank just hands the file to the Treasury and says, send me the money. And the Treasury does. And then the Treasury, probably keeps the same servicer and tries to collect. So, but it's at that point, it's at the point where the Treasury writes the check to the bank to honor the guarantee that it goes into the deficit. So this is just coming on stream now. And this looks like $200 billion a year. So you're looking at $1.4 trillion for the tax cut, $300 billion a year for the removing the sequester, $200 billion a year for student loans. This is $2 trillion, and in the case of a lot of it, it's recurring, so it's $500 billion a year. This is on top of the baseline budget, which was already in deficit. So these are huge deficits. The only way out of this is if you can actually if you can get 5% growth, 4% real growth, and combine it with 2% inflation, so that's 6% nominal growth, and keep the deficits to 5% of GDP, so that your nominal growth is slightly greater than your increased deficit. If you can do that, then the debt to GDP ratio will plateau and then start to come down slowly, but start to come down. But that's not happening. I mean, what I just described is not happening. The 4% growth looks temporary as a result of the economy being goosed by the tax cuts. There's not going to be another tax cut in January 2019. It was great for 2018, but when you get to January 2019, you're operating off a higher base of growth. You're not going to have the growth stimulus that you had. So you can see GDP drop down to 1.5%, 2%, which is where it's been averaging the last 9 years. But all these deficit items I mentioned, the student loans, the removing the sequester caps, et cetera, are all going to remain. And by the way, the $1.4 trillion cost of the tax cut, that's based on projections that show 3.5%, 4% growth and no recessions. Who thinks we're going to go 10 years without a recession? We might not go 10 months without a recession. So putting all these things together, I think the growth prop is temporary. I don't see inflation. Actually, in the most recent report, core CPI, which is what the Fed watches, came down a little bit. It's at 1.8%. That's not far from their target, but it's down from the 2% target. Inflationary expectations are up. Well, maybe, but that's not inflation. Expectations in real data are not necessarily the same, often not the same. People talk about consumer confidence. Consumer confidence is not a leading indicator. It has no predictive analytic value. Consumer confidence is a concurrent indicator that is closely correlated to the stock market. As consumer confidence, people go, oh, well, people are confident they're going to go buy refrigerators and washing machines and new cars and all that. No. What it correlates to is the stock market. If the stock market goes up, people think happy days are here again. The minute the stock market turns around, consumer confidence turns around. So that doesn't tell you anything. So putting all this together, I see inflation turning around. Consumer confidence doesn't tell us much. Stock market's hitting choppy waters. Growth The pop was temporary, but the budget deficits are real. So this is everything I just described is a recipe for lower growth, worse debt to GDP ratios, at the margin, loss of confidence in the U.S. dollar. The problem with losing confidence in the U.S. dollar is there's nowhere to run.
Mm-hmm.
I mean, what are you going to do? Buy Turkish lira, Indonesian rupiah, Chinese yuan? You're not going to buy any of those things. But you might buy gold, and I do think people will do that.
So with all this debt out there, let's talk about interest rates, right? Always such a outsized topic. So the Fed's begun raising interest rates. We know President Trump has been quite vocal what he believes, whether it's a good idea to be doing that, which obviously he isn't. He's been quite critical and public about it. Now, do you see a continuation of the Fed raising rates, and do you think that they have a target in mind? And if you see them continuing to raise the rates, generally the higher rates can cause a crash in the stock market and put a lid on gold prices. So where do you see interest rates going? What do you think is the model or the plan at the Fed? And how do you see the stock market and the precious metals market reacting to that over the next 12 to 24 months?
Right. Well, I see kind of train wreck coming. I think you cannot, it's a mistake to presuppose the Fed knows what they're doing. The Fed does not know what they're doing, but they're doing something. They think they know what they're doing. So when you're doing Fed analysis, you have to put aside what you think about the economy and put yourself in their frame of reference and say, well, what do they think? Because that tells me what they're going to do. Mm-hmm. So the Fed has been raising interest rates, as you said. My Fed model, which I actually got from one of the Fed governors who kind of walked me through this, is very simple. They're going to raise rates 4 times a year, every March, June, September, December, 25 basis points each time, like clockwork, until they get to a level that would be at this point at least 3.5%, possibly higher, but at least 3.5%. So this is going to be going on for another, all 2019 into 2020, like clockwork. It's not hard to predict, with several exceptions. And so it's the exceptions that matter. The policy is what I just described. What are the exceptions? What are the conditions under which the Fed would not raise rates? And they call it taking a pause. So will the Fed take a pause? Well, there are 3. One is a job creation dries up, or you actually get it into job losses. That's not happening. Now, it is true that job creation has sort of, gradually declined from, 250,000 a month to maybe 130,000 a month. But that's not negative. That's not job losses. And it could even go as low as 75,000 a month, which would be the low pretty much for the cycle, other than, I think, 1 month during Hurricane Irma. But that being the case, it looks like the job creation machine is still going strong, certainly strong enough to keep the Fed on track. The second one is deflation or strong disinflation. So if you saw that core CPI number I mentioned drop from 1.8% to, it'd have to go down to like 1.4% or lower, then the Fed might take a pause. Well, that's not happening right now. It could happen over 6 or 8 months, but it's not the case today. The third element is a disorderly stock market. Now, when I say disorderly, there's a definition to that. It's got to be down, the major indices have got to be down 15% in a fairly compressed period of time, let's say 4 weeks or 5 weeks, something like that. If the stock market went down 15% over 6 or 8 months, the Fed wouldn't care. They say, hey, that's not our job. You stock investors need to take care of yourself. If the stock market dropped, 3-4% one day, which it did recently, the Feds, we don't care. That's not our problem. But the point being, the stock market recently was down, 3 to 4% in one day. The Fed says that's not our problem. That's on you investors. The only time the Fed cares about the stock market is if it has the potential to cause systemic risk. In other words, the decline is so sharp and disorderly, that's the word they use, that it risks contagion, so it could spread into other stock markets, housing markets, turn around consumer confidence, cause disinflation, do all the things that we just talked about when we were discussing growth. So what is that metric? Well, as I said, the metric is down 15% in 4 or 5 weeks. So you'd have to see the Dow go to approximately 21,500 from today's levels. Well, if you see the Dow go to 21,500 before Thanksgiving, or maybe even sooner, before early November, they might pause in December, but we're not there yet. In fact, we're not anywhere close. We just had a couple bad days. So the 3 pause factors are not in play. Therefore, I would expect the Fed to raise rates in December, and we'll see what happens in March. So that's the Fed model in a nutshell. Now, here's the problem. They're not just raising rates. They're burning money. They're doing QT. Everyone, you talk to gold investors or everyday people, they're still complaining about QE, quantitative easing. QE was over in 2014. We're now into QT, which is quantitative tightening. The Fed is actually reducing the money supply. The famous picture of Ben Bernanke hanging from the strut of a helicopter, tossing dollar bills, $100 bills out the window. Well, imagine Jay Powell standing next to a furnace with a shovel and a pile of money, and he's shoveling the money into the furnace and burning it. Well, that's what the Fed's doing. Now, that has a monetary tightening effect. Now, this is, by the way, everything I'm describing now is experimental. When I say experimental, it's never been done before. The Fed's been around for 105 years, and they never did QE the way they did from 2008 to 2014, and they've never done quantitative tightening the way they're doing now. So we're just guinea pigs in this big Fed experiment, but it certainly has a tightening effect. The estimates vary, but the best estimate, I believe, is that it's about 1% a year. In other words, reducing the money supply by $600 billion per year, which is what they're doing, is the effect of about a 1% increase in interest rates. So you take the 1% that they're doing in the nominal rate on Fed funds, add another 1% that they're doing implicitly through quantitative tightening, they're actually raising rates 2% a year. This is real. I mean, this is a very steep increase in a very short period of time with not much inflation. So they're not only raising nominal rates, they're raising real rates. And I actually pay more attention to real rates because that's what, nominal rates are important in terms of the debt to GDP ratio, but real rates are what matters in terms of stock market and gold and other alternative investments. So, so they're raising real rates a lot. That's a drag on the stock market. It's also a drag on growth. So right now, the Fed is sort of going along with the Art Laffer, Larry Kudlow, Donald Trump version, which is, hey, you cut taxes that much, you're going to stimulate the economy, we're going to have high growth, unemployment's 3.7%, job market's tight, wages are going to go up, there's going to be, demand, driven inflation, and we have to get ahead of the curve and raise interest rates. Everything I just said is nonsense. I mean, it's what the Fed believes, but it's not what's happening. The growth, in my view, is temporary. We're going to see much weaker growth in the near future. The unemployment rate is not 3.7%, it's 10%. Now, it's 3.7% the way the government calculates it, but if you look at what's called U3 unemployment, these are the people who wish they had full-time jobs but don't, and so there's slack there. And then in addition, we have about 10 million Americans able-bodied between the ages of 25 and 54 who are out of the workforce. Now, these are not retirees because they're under 54. They're not disabled. Some of them may collect disability checks, but any doctor will give you a note that you have a sore back. I mean, there's some real cases, but not most of them. They're not counted. So if you put that group in, plus the part-time workers who wish they were full-time, and add them to the unemployed, you get to 10% unemployment. That's a depression level of unemployment. And that's why wages are not going up. That's why we don't see the inflation. If unemployment with all the people I mentioned included were 3.7%, yeah, we'd have screaming inflation. But we don't because there's a huge slack in the labor markets. Not to mention the deflationary impact of overseas labor from China and South Asia and elsewhere around the world. So you're going to lose the growth quickly. You're not getting the inflation. The economy's slowing. raising rates and burning money are a major headwind to the stock market. So I think the Fed's going to wake up one day sooner than later, maybe meaning in the next 6 months, and say, wait a second, we just over tightened once again. We put the economy into a recession once again. We have to reverse course, and they'll start by pausing. Well, that signal, when they pause, that's tantamount to saying that they build a room that they can't get out of. They can't escape the room. That the impact of QE and zero rates for 6 years, no rate increases for 9 years, $4 trillion of money coming out of thin air, that they could do those things, but they can't get out of them, not without sinking the economy. So they're stuck.
So if they go into a pause mode, the next move after that is probably going to be cutting rates, not resuming the uptrend?
Well, possibly. They have a couple tools. One is cutting rates. You're absolutely right. But the other one, and they swore up and down they wouldn't do this, but of course they'll do whatever it takes. They could reduce the QT. They could say, all right, we're going to hold rates constant, but instead of $600 billion a year of destroying base money, we'll dial that down to $300 billion a year. So that's another easing tool they have at their disposal. But you certainly can't rule out rate cuts. I think that's on the table, would be on the table. And then what happens when you get to zero? Well, now you're back to QE. Now QE4, QE5. And this is the point, that they have their solution to the economic panic of 2008 was to construct a monetary system that they can't get out of. They can't escape. They can't reverse it without, in effect, suffering the pain that they tried to avoid in 2008.
So with that said, it looks like they're stuck going in a circle since 2008. They created this environment, and now there's no way to get back to what you would call a normal economy, normal central bank policy and procedures.
No way without causing a recession, and that's the point. By the way, why is the Fed raising rates at all? We talked earlier about they're on autopilot, 4 increases a year, target of 3.5, 3 3/4, whatever. Why are they even doing that when there's not much inflation and job growth is good and the economy is nevertheless facing some major headwinds? Well, the answer is they're not doing this for normal business cycle purposes. The normal business cycle is the Fed sits there and does nothing. They watch the economy gets stronger, unemployment goes down, and that's continuing. And then GDP is up, unemployment is down. All of a sudden, inflation shows up, and they go, oh, gee, we better hike rates. And they hike rates, but of course, they're always too late, right? Monetary policy operates with a lag, and they sort of know that, but they don't practice it because their forecasting tools are so dismal, are so deficient. The Fed has never forecast a recession, by the way. We've had something like 15 recessions since the end of World War II. The Fed has never forecast one of them, so they don't do that. So you see inflation tick up, so they raise rates, and they're behind the curve, and inflation gets worse, and they raise rates some more, inflation gets worse, and they raise rates some more, and then all of a sudden, they wake up and they over-tightened, and then we're in a recession. And they watch that for a while, and unemployment's going up, and inflation's coming down. They go, oh, now we better cut rates. They cut rates, and then the economy gets going again. Well, in other words, the Fed never leads the economy. They always lag the economy. They always follow the economy. And the data shows that it takes between 300 and 500 basis points of rate cuts, 3 to 5% of rate cuts, to get the economy out of a recession. Well, how do you cut rates 400 basis points when you're at 225? The answer is you can't. You can cut them to zero, but you're still stuck. You have not given the economy enough of a monetary boost, and so then you're right back to QE4. Although at this point, but bearing in mind, you would be starting QE4 from a much higher base. They started QE1 at a base of 800 billion. Today, they'd be starting QE4 at a base of $4 trillion. So are they at the point there where QE wouldn't have the same effect because people would begin to lose confidence in the dollar? That's a possibility. So they're desperately trying to raise rates and reduce the money supply so they can get us out of the next recession. But the question is, in the course of preparing for the next recession, will they cause the recession we're trying to cure? And my view is they will.
So now let's talk about something that's a little more real speculative, especially when most people, are affected to some degree by what they call the normalcy bias, right? We both know what that is. And this is the future of the Fed. It appears that the Trump administration is an antagonist to the Fed. We know about President Trump's admiration for Andrew Jackson.
Right.
So let me ask you, there's talk and there's speculation in some quarters that if we were to get a financial event of the magnitude of 2008 or probably greater, the next one will be greater, and I think you would concur with that, could that be used as the pretext if the Trump administration is still in power to try to eliminate the Fed or alter it in some way?
Well, it's a great question, and you can't rule it out. I actually don't think so, and I'll tell you why. It's like if you're a boxer training for a fight, you have a punching bag in your gym. You don't want to get rid of the punching bag. You want something to work out on. And I think Trump, does he actually dislike Jay Powell? Does he actually dislike the Fed? Does he actually want to dismantle it? Or is it a punching bag? And I think Trump, one of his characteristics is when he claims credit for every success and denies responsibility for every failure. So that's just Trump. That's how he rolls. So if you saw continued stock market declines, and if you saw the economy sort of head into a recession, I think the Fed makes a very convenient punching bag because the Fed's at least nominally independent. Trump can sit there all day and blame the Fed, yell at the Fed, call the Fed names. If he got rid of the Fed, it would be back on him. Everyone would look at the White House. So I think the Fed makes a good person to blame. Yeah, good whipping boy. Well, when in the intelligence community, when you get, one of the things they train you on is what happens if you get captured. What happens if you get arrested in a foreign country? And there are 5 rules. And the first one is admit nothing. Second one is deny everything. Third one is blame somebody else. The fourth one is ask for proof, et cetera. So Trump seems to, someone put that coffee mug on his desk, but he seems to be, blaming others and admitting nothing himself. And that's okay. It's good politics. So I don't think you would want to get rid of the Fed, but bear in mind, Trump kind of owns the Fed. He's had more vacancies and appointments than any president since Woodrow Wilson. And the only reason Woodrow Wilson got so many was that's when the Fed was created in 1913. So he had an empty board other than a couple of statutory appointments. So he got to fill it up. But, every president gets 1 or 2 picks, but Trump's had 3 already. And if I'm not mistaken, I believe there's still a vacancy on the board. So you're going to look around and say, well, he made Jay Powell chairman. He put Randy Quarles on the board, and he put Richard Clarida on the board, and he's got 1 more pending. So it's going to be Trump's board of governors. So what's he going to do? Blame them when he appointed them? So I think it's going to be difficult. What I would expect, if you do get into a crisis worse than 2008, which I think we're heading for, it's not so much that they would try to eliminate the Fed or dismantle the Fed, other than kind of blaming it day to day. I do think we'd be back to where we started in this conversation, which is the reset, that they would have an international monetary conference. And the central bankers would be invited, but it would be more the heads of state and the finance ministers and Secretary of the Treasury. And they would try to put Humpty Dumpty back together again. They would try to reassemble the international monetary system in a way that people had confidence in it. And that could very well include gold. In fact, I think it will. And by the way, going back to what we talked about a few minutes ago, Chris, even in the short run, if you see the Fed throw in the towel and go to pause, or you see a loss of confidence in the dollar, gold's going to soar. It's just going to scream because, right now, the reason the dollar is so strong is because no one likes the alternatives. Europe's got a black eye because of Italy. UK's got a black eye because of Brexit. China has no rule of law. Russia has no rule of law. So you're like, gee, where am I going to put my money? The Australian bond market's not that big. You end up getting forced to invest in dollars and treasuries because there's nowhere else to go. But there is somewhere else to go, which is gold. And if you're a gold expert or you understand monetary history, you can see the value in it. But most economists don't. Most economists have nothing good to say about gold. Most wealth managers, they're more afraid of getting laughed at than they are of losing money. They figure if they lose money and everyone else loses money, they just shrug and say, well, I did the same thing everyone else did. But they don't want to be laughed at, so they won't touch gold. But the fact is, some allocation to gold, and I've always recommended 10%. An allocation to gold is, first of all, a very good diversifying move. It's a very good asset to have in your portfolio. But above all, it's insurance against all these other things we're talking about: a monetary reset, inflation, loss of confidence, a new financial panic. You go down, as I say, trade wars, currency wars. You go down the list of things we're talking about. Gold protects you against all of them. So I don't understand why people wouldn't have some allocation. Again, I recommend 10%. If you like 5%, you can kind of season the taste. But I don't know how people sleep at night with no gold.
Sure. So, and you've pretty much answered this question, so I'm just going to kind of summarize it. Investors, they have expectations. Sometimes the timing isn't what they expected. And we're talking about really gold investors. Now, for this year, 2018, gold has basically been trading sideways to down. And that's frustrated some people and perplexed some people. What would just be a very, your short message to them as far as those who currently hold gold, what their mindset should be, and those sitting on the sidelines debating whether they should take a position in gold or precious metals?
Well, I think this might be the last call for gold at a reasonable level. You're right. And by the way, the trading sideways, the last 3 months, so August, September, October, it's not just sideways, it's in a really tight range. I mean, with the exception of a couple of small blips, it's trading between 1185 and 1215. Well, that's a $30 per ounce range. And if you center it around $1,200 per ounce, that's a 2.5% range. That's a really narrow range given the volatility in currencies and stocks and everything else. So the last time gold traded in that narrow a range for this long was December 2015. And it broke out. And you had one of the best rallies in gold in 10 years. Gold went from 1050 in December 2015. Gold went from 1050 an ounce to 1360 an ounce just after Brexit. Now it's backed off from there, obviously, but again, I look at that. The last time gold traded in a narrow range the way it is right now, it broke out to the upside and rallied 30% in 6 months. So so I don't see. And when people say gold's not going anywhere, I'm like, well, I'm surprised it's not going down. I mean, real nominal interest rates are going up. Real interest rates are going up. The Fed's on a path to raise rates. They're reducing the money supply. There's a trade war, a currency war. You look at all the factors, and all of them would predict lower gold prices because they're all either deflationary or they make fixed income instruments more attractive to alternative to gold, which is not, which doesn't have a yield, et cetera. And yet gold's not going down. So I'm very encouraged by the fact that it's trading sideways in a world where a lot of factors tell you it should be going down. Now, on the plus side, factors that are putting a floor under gold is simple, good old-fashioned supply and demand. Russia, as I mentioned earlier, Russia has tripled its gold reserves in 10 years. China has tripled its gold reserves in 10 years. Russia's a lot more transparent about it. They're buying about 30 tons a month. That's a lot of gold, as you know, and they've been doing that through thick and thin. From late 2014 to late 2016, Russia's reserves dropped 40%. They went from about $500 billion down to $300 billion. So you had a 40% drop in reserves, but they never stopped buying gold. Not only did they not sell gold, they kept buying gold through thick and thin. When the reserves were going down, they were dumping dollars, treasury notes, mortgage, U.S. mortgages. They had to lose certain things, but they kept buying gold through the whole thing, and they're continuing to buy it today. So you have to say to yourself, are the Russians stupid, or do they see something we don't, or that most people don't? Well, I know Russians. I spent a lot of time in Russia. They're not stupid. They know exactly what they're doing. They see the reset coming. They understand the importance of gold in the future of the international monetary system, and they're just getting ready for some kind of shock that most people are oblivious to. So I say if it's good enough for Russia and China, it's good enough for me.
I agree. We say all the time to our clients, believe me, the heads of state of countries like China and Russia have a much better seat at the table than we do. And they're privy to the workings of the world monetary system in a way that we'll never have. So if you're looking at their actions with the data that they're exposed to, it's probably a lot wiser to follow their moves. And from a technical trading perspective, Jim, you're exactly right. When the trading range gets narrower and narrower, a lot of times on a chart it'll look like a wedge.
Right.
When it finally breaks out of the wedge, it doesn't creep out. And this is for anything that's trading, right? Stocks, gold. When it breaks out of that wedge pattern, the move is generally dynamic, robust, and powerful. So I would agree. It looks like it's setting up, right? You look behind the scenes, gold is being accumulated aggressively by some very smart players. You're looking at a pattern that's getting a tighter and tighter range, telling us the probability is a big, robust breakout to the upside, and not in the real distant future, probably in the intermediate to short term.
Yeah, I agree. And so you're right. When you see the wedge and you say, okay, that's a signal that it's going to break out. And then the skeptical investor can say, well, it could break out to the upside or break out to the downside. And that's true. Right. But the deck is stacked very much in favor of a breakout to the upside. And the reason for that, I mean, just to be empirical, using futures contract data, the short position is at an all-time high. I mean, the hedge funds, when you say smart players, all right, I'll agree that Xi Jinping and Vladimir Putin and Avara Nabiulina and some others have more access to information than we do, but I don't necessarily put hedge funds in the same category as the smart players. They tend to move in a herd. They tend to believe what they read in the headlines. They treat gold like soybeans. They tend not to be that sophisticated about monetary policy and monetary history, and they are massively short. So even a small break to the upside, which is what I expect, could accelerate into like a skyrocket, because they're going to have to cover their shorts. Independent of people who want to buy gold for the right reasons, you're going to have a lot of people buying gold just to cut their losses. So it could be extremely dynamic.
Yeah, and agree. And comparing the insight of a hedge fund manager, not to be mean, I mean, they're very tactical and short-sighted, right? As opposed to China and Russia, who are very strategic, right? So, they're looking at gold and participating in that market with completely different mindsets and resources. So I think we're both on the same page on that, which is going to lead me to my next thing. Gold is used to refer to gold, and sometimes just as a blanket de facto for the whole precious metals market. And we have 4 other very important precious metals: silver, platinum, and palladium. And for the last several years, palladium has been knocking the cover off the ball. I mean, its increase has been tremendous. So even though central banks do not use silver, platinum, palladium as the reserve asset, silver and as a quasi-monetary metal, industrial metal, it is being acquired around the world. Platinum, palladium are industrial metals, but have very interesting dynamics, not only a supply-demand, but the limited places from which it is supplied from. So with all that said, and they do possess some characteristics of gold too, right? They're a store of wealth, they're a hard asset, they're highly divisible, they're highly portable. With all that said, what is your opinion on silver, platinum, palladium? And do you see a place for them within a person's precious metals portfolio?
Right. Well, first of all, Chris, you're exactly right. Gold is a pure precious metal. Gold's actually not good for much except money. I think it's the best form of money, but it has very limited industrial applications. Use it in some there's actually a 5/9 kind of gold that's incredibly expensive, way more expensive than normal gold bullion. that's used for ultra thin wires in certain telecommunications devices, and they use it to coat the helmets of an astronaut. But it really has very few applications. And we look at the World Gold Council; they show a big slug, almost 20% of gold purchases being for not for investment, in other words, but for commercial usage. Well, when you look into that, it's jewelry. Sorry, jewelry is a store of wealth. To me, jewelry is just wearable gold. You know, an Indian bride with 20 solid gold chains draped around her neck, that's not decorative. Maybe it looks a little bit that way, but that's her dowry. That's her store of wealth. That's her kid's college education. That's a new house. So that's how they think about it. So I count all the jewelry as the same as bullion and coins. When you do that, there's almost no industrial application for gold. Very, very few. So that's pure. Now, silver, the other silver, platinum, and palladium, you're right. Silver's another precious metal, but it does have industrial applications, a lot of them. So silver is difficult to analyze because if you look at it as pure money, you're not getting the whole picture because, car sales can affect it and other, as I say, other applications affect it. Platinum and palladium, primarily industrial metals. But interestingly, they do have a lot of the qualities of precious metals. They have all the ones you mentioned, scarcity and uniformity. There are elements. The one I like is they don't rust. In other words, so many things that people put store in actually degrade. They wear out, they fall down, they rust, they wear and tear. The precious metals don't, and including platinum and palladium. The four of them, the group of four you mentioned, are called the noble metals, and the reason they're called that is because they have these characteristics we talked about. So that said, I'm not an industrial expert or an engineer. I can't speak expertly on the use of platinum and palladium in industrial applications, but I do obviously do study the monetary system, and I do study risk and investment management and portfolio allocation, and I understand the power of diversification. And you have a product that is called the precious metals ounce, the PMC ounce, which is a portfolio that when you buy one, it's priced and allocated in such a way. You buy 100, obviously one would be a fairly small allocation, but buy as many as you like, and you actually get a mixture of those four precious metals in a proprietary mix that you have invented and patented. And I like that a lot. I like the diversification it offers. And you know better than I how it's been performing. It's been performing extremely well. And the reason is simple. There are times when gold goes down, but palladium goes up or platinum goes up. And then there are other times where maybe platinum and palladium are going down and gold's going up. The point is something's always going up, sometimes all four of them, but always at least one or two, sometimes more. And that basically gives you a higher total return with less volatility. It's the holy grail of investing. Anybody can get a higher return by taking more risk. Usually the risk you take isn't worth the return. The holy grail is, can I get a higher return without taking more risk, or at least only take risk that's less dangerous than the return I'm getting? And that's beyond the efficient frontier. And you get that from the PMC ounce. So I really like that product for that reason.
Well, thank you, Jim. One last thing, you have such a great insight. You have relationships with refineries around the world, vaulting companies. You really know the nuts and bolts and the nuances of the precious metals world. So a big concern of a lot of investors when they're trying to make the decisions of not only what to buy, what form, but about storage, right? Should I hold it in my possession at my home? Should I use a vault that's insured? What would your recommendation, or what would you say to people as far as, once you have these metals, how best to hold them? And also they need to keep in consideration, what is their objectives? Are they saying that when gold hits $5,000 an ounce, they're going to sell? So of course they need to get it back to market quickly. But just what are your thoughts in the area of holding gold and storing gold?
Well, there are a lot of choices. The first thing I tell people is do not put it in a bank, bank safe deposit box or a bank vault. And the reason is It's extremely safe when you don't need it and totally at risk when you do need it. In other words, there's a high conditional correlation between the day you most want your gold and the day the banks are shut. So people are going to be banging on the doors saying, let me in, I want to get my gold. And they're going to say, sorry, we're closed by government order, and we're going through all the safe deposit boxes, and we're confiscating all the precious metals and cash, and we'll send you a receipt. So so that doesn't work. You don't want to put it in the bank. Private, secure, non-bank storage is the best. There are a number of reputable vault companies out there. You have to do your homework a little bit. You want somebody who's been around for a while. You want obviously someone who's bonded and assured, good reputation, good references. You want to be able to visit the vault and see your metals. So I'm sure there are thousands of them. I don't know them all by name, of course, but I'm sure there's some fly-by-night operators out there. But if you do a little homework, I mean, you have a vault, very good company. There are a couple other big ones out there. You know, there's Brinks and Viability and others, Loomis. I visited one of the largest, most secure gold vaults in the world outside of Zurich, Switzerland, not long ago. And I talked to the head of precious metals and said, how's it going? And he said, we're running out of space. We're having to build new vaults. We're acquiring these hollowed out, secure mountain sites from the Swiss Army. The Swiss Army is giving them up, and we're buying them with multiple security perimeters and all that. I said, oh, it's interesting. So where's the gold coming from? And he said, UBS, Deutsche Bank, and Credit Suisse. In other words, it's not that there was a big gold discovery or a lot of gold showed up. He said people are moving it from the banks to the non-banks in safe private storage. And so that told me all I needed to know. So my recommendation would be find a highly reputable, seasoned private vault operator, someplace you can get to fairly easily, but not a bank.
I agree. And we've seen the same things, Jim. We've had, we work with a non-bank bullion depository for our clients. We have a very integrated offering, and we've seen the same thing. Very big players who have some big holdings in precious metals moving it out of the bullion banks, vaults, into the non-bank depositories. So, that's transpiring around the world. All right, so I just want to wrap up. Your newsletter, your books have been very informative for people. They've given them a blueprint to really understand the global monetary and financial system. They've been really invaluable to people who are interested in the markets and what's going on in the world. What project do you have going on now? What could your fans expect from you, in the not too distant future?
Well, I'm just finishing a new book, putting the finishing touches on it. It's there's more to getting a book out than just writing it. Writing it is hard, and researching it is hard. But you've got editing and copy editing and legal reviews and cover a lot of logistics and associated with that. But the new book will be coming out next spring. Right now we're targeting March. We'll see. I think we'll hit that target. So March 2019. It's volume 4 of the 4-volume treatise on the international monetary system. So volume 1 was Currency Wars. Volume 2 was The Death of Money. Volume 3 was The Road to Ruin. And volume 4 is called Aftermath. So that's the one coming out. I'm finishing that up now. It should be on the bookshelves or available on Amazon. You can pre-order it now if you like. That should be coming out in the spring. Other than that, continuing research, looking at the what is an implied peg of the gold in SDR prices, not dollars, not yuan, but SDRs, that is possibly being engineered by China. Traveling, speaking, just enjoying life.
Sure. And just, is there a particular website or anywhere for contact where a person can go to keep up with what you're involved in and to see, maybe how to subscribe to your newsletter or find out when your next book is coming out? Anything with that sort of information?
Sure. My personal website is called thejamesrickardsproject.com. So if you just Google James Rickards Project, you'll find it easily. And then that contains a lot of links to my books and newsletters and so forth. My financial publisher, my newsletter publisher is Agora Financial and the Paradigm Press in Baltimore. They have a very active website. And then, of course, the books are available on Amazon. And I'm also very active on Twitter at James G. Rickards. So I use my middle initial, Rickards, Rickards. So and it's an open account, so you don't have to join Twitter. You can if you want to, but you don't have to join Twitter. You can just Google at James G. Rickards and it'll come up. And I put out a lot of commentary on the international monetary system and monetary policy right there.
Great. Hey, Jim, thanks a lot for coming on our show. You provided us with great insight. We really look forward to sharing this with our clients and other people out there. And we hope to have you again on in the future as we kind of chronicle and track the Great Reset.
Thanks, Chris. I'll look forward to it.
Okay, Jim.